In today's video, we're going to discuss how stagflation affects our Yieldmax investments. Our Yieldmax investments help us earn over $250,000 per year in dividends at this channel, as you can see, and our performance value shows that year to date we're beating the market handedly with our Yieldmax ETFs. We're up 10.6%, whereas the S&P is up 6.9, the Nasdaq's up 6, the Dow's up 1, and the Russell's down 1. Also on a daily basis, we're at 0.82%, which beat the Dow above, as you can see. As long as we're going with the indexes, then we'll continue to outperform, especially because we use some margin. The margin helps us live the FIRE lifestyle, which means financially independent, retire early. If you need help doing the same, email me for my e-guides at aikentod48@gmail.com. So I have 5 points that I want you all to consider when it comes to stagflation and our Yieldmax ETFs. The first reason being that dividends from Yieldmax are based on volatility, not net income of that fund. So if we go to a snapshot of Tesla, which is a popular Yieldmax fund, you'll see that it has a monthly dividend of around 59%. Well, this volatility is based on options, not earnings. Once again, so if Tesla has a bad earnings report, they're still going to have options. They're still going to have volatility. Maybe those will fluctuate, but as the stock price rises again, those premiums will rise as the volatility rises. So I'm not worried about stagflation when it comes to Yieldmax because the dividends come regardless of stagflation, whether we're in a bull market or a bear market or a sideways market. Again, dividends from Yieldmax are based on volatility, not the earnings of the stocks themselves. The second reason why I'm not worried about stagflation with Yieldmax funds is that the dividends cash flow the losses regardless. So even if you're in a Tesla and it's been down for you, if you just hold this fund for more than 2 years, well, then you're paid back in full because 60% times 2 years is 120% payback. I get constant complaints about Defiance and Yieldmax and their erosion. Are they going to be able to sustain this dividend payment without going to zero and blowing up? Well, they'll just keep having reverse splits. And then I don't understand people's issue with reverse splits. They don't change the dividend. As you know, reverse splits don't change anything about a stock. It's just cosmetic. So anytime you hear any people on YouTube saying there's going to be a reverse split and bad things are going to happen, they are novices and it is amateur hour. Just go look up a definition of a reverse split, which I've already showed you in past videos on Tesla, and you'll see that there is no impact on a stock when it has a reverse split. If anything, it just raises our equity because when you raise the share price, you lower the maintenance, which then raises our available withdrawal up to a healthy number so that we can continue to live the FIRE lifestyle and not only have this margin debt of around $343,000, which my dividends pay back in around 1 year, but we can also withdraw freely out of our account. Even when in debt, you can still take your E-Trade credit card and swipe it and go wherever you want in this world and live freely from a 9 to 5. You can buy anything with margin. Elon Musk bought Twitter with his margin debt. So NAV erosion is a myth once again when it comes to these dividend funds because no matter what happens in the share price, if you hold them long enough, the dividends cash flow the investment. Again, why don't people see this point? It's really starting to frustrate me, especially with Defiance funds. Yes, Defiance, they go sideways to down. QQQY, for example, it has a huge dividend, a 68% dividend, but it goes sideways to down as you can see on its charts. Well, we're down about 8,000 in each Defiance fund, QQQY, JEPY, and IWMY, but we receive 10,000 a month in dividends from these Defiance funds. And we've been owning these Defiance funds since October. So if you do 10 grand a month times about 7 to 8 months, you'll see that we're up around 80 grand, but we're down around 30 grand on paper. And everyone who follows my portfolio can see by my allocations and my losses in my gains and losses column for Defiance that I'm only down again around 10 grand in those funds each on paper, but I received 80 grand total in dividends. So you have to factor back in dividends when trying to calculate your total performance. A lot of people say their performance is struggling just by looking at the red in their portfolio. Well, I have red in my portfolio and I like it because I can declare those for losses and harvest them at tax time, and then my dividends just keep coming in uninterrupted, and that's where we really get our performance because our dividends come off of margin. For every $1 you put in your account, you get $4 of purchasing power, and I'm just using a fraction of that margin power to get ahead. So our dividends pay this back regardless, and they also help give us this outperformance beating the market. It's because of dividends on margin. Leverage dividends gives you growth without market gains. But when the market does grow and go up, let's say 1% on a given day like it did on Friday, we also get the day's gains. We don't get the full day's gains because we're buying funds that kind of go sideways to down or don't move up completely like the indexes like Cornerstone, Defiance, and Yieldmax. They have some erosion or capped upside. But when we get our dividends, that gives us the rest of our performance. And our dividends on margin margin give us even more performance. And that's how we outperform the market and live the FIRE lifestyle, which means financially independent, retire early. But you have to watch your maintenance. When it comes to Defiance and Yieldmax funds, maintenance is the whole key to living the FIRE lifestyle. As you can see here, 50% maintenance for QQQY and Yieldmax, let's say YMAG, Tesla is the same. If we go to a snapshot of YMAG, you'll see maintenance requirement here is also 50%. This is a killer to the FIRE lifestyle. And this is why I put a bulk of my money in Cornerstone, which is CRF. CRF has 30% maintenance. So if you want to live the FIRE lifestyle and you want to buy indexes and dividend funds that cash flow no matter what the stock price does, similar to real estate, if your house goes down in price but the renter keeps paying you rent every month, well then eventually you cash flow it in 15 to 30 years regardless of what the house price does. Same for these dividend funds, but you have to have low maintenance dividend funds, and that's why I put so much of my money in Cornerstone. If you need help understanding maintenance, that's in my Volume 3 e-guide. Cornerstone, by the way, it is a 4-star fund, but you have to play this fund around its rights offerings, and that's in my Volume 4 e-guide. Discord access is free for life when you buy my e-guide. Also, we alert you of the Cornerstone rights offering announcement here in Discord. We have almost 1,000 members here in the Discord chat room pursuing the FIRE lifestyle who can help hold your hand and walk you through the FIRE process, because after all, I was all alone when I started this whole system. I had no help. I had no one on YouTube that I could consult. I had to learn this all on my own. I had to go through the 2019 bear market, the 2020 crash, and the 2022 bear market. I had to go through all these corrections and learn what worked best with margin and these funds that pay high dividends but go sideways to down over time. I had to learn the system all on my own, and I had to learn how to trade Cornerstone all on my own. And also, Cornerstone has a 21% dividend that it drips down at the NAV for free money every month. So not only does Cornerstone beat the indexes on a 10-year time frame, but that 21% dividend is dripped down at the NAV for free money every month. I don't know of any other funds that do this, and it's 30% maintenance. So that's how I live the FIRE lifestyle. It's with Cornerstone. 400,000 of my dollars are parked in Cornerstone, and then the rest of my account, including this margin, is in Yieldmax and Defiance funds. I just don't want to hear any negative comments about Cornerstone and how it goes sideways to down on its chart over time. You have to factor back in dividends and drips. Same for Defiance or Yieldmax. I don't want to hear negative comments about how they go sideways to down and how can they sustain this dividend yield. Well, they'll just have a reverse split, which changes nothing about the stock. It just raises your equity as the maintenance is lowered from a higher share price. My third reason for not caring about stagflation with Yieldmax funds is that margin knows no stagflation. Okay, this margin debt that I have, this 330,000 or 343,000 of margin debt that you see here, this does not know what stagflation is. I can use this margin debt whenever I want, okay? So you don't have to apply for margin. It's automatically granted to you with a brokerage account. At E-Trade, you have to have 25,000 to get the 4 times power, but at other brokers, you can have less money and get 4 times. You can, again, be granted this margin purchasing power for free immediately when you open a brokerage account, as opposed to a Roth or a IRA. And then the margin gets paid back regardless of market conditions because the margin is paid back by dividends. So the system that we have works regardless of an up or a down market. This debt doesn't show up on a credit check. I can click sell at any time. This is low interest debt. I've negotiated down twice. Many of my clients who bought my e-guides did the same thing. And again, for every $1 you put in your account, you get $4 of purchasing power. So none of this is affected by stagflation, inflation, or deflationary times. Whether the market's up or down, whether GDP is strong or weak, we continue to get our dividends based on options or based on the NAV of the S&P. Cornerstone's dividend is based on the S&P. It doesn't matter what the dividends are for their S&P holdings. They don't rely on S&P dividends. They just rely on return of capital, which is tax-free if the NAV is growing. And the NAV for Cornerstone is based on the S&P, so the NAV is always growing. So therefore, the return of capital that Cornerstone gives you is just a tax-free investment if the NAV, again, is growing. My fourth reason for not worrying about stagflation is that tech companies within the S&P aren't affected by stagflation as much as they were before, since they have reoccurring revenue with software as a service, SaaS. Many tech companies now have software as a service, again, where they have reoccurring revenue, such as a Netflix or an iTunes with Apple, or Google with its data storage, Amazon with its Prime subscription. Again, you have software as a service with these technology companies that make money monthly regardless of our purchases as consumers. Now with software as a service revenue models, we have less boom bust cycles. Also, because GDP is 70% consumer driven, we'll always keep consuming regardless of the economy. So even if we have to consume less of this item over here and substitute it for an item over here, which is economics 101, then we'll just keep consuming which again, our GDP is 70% consumer driven. Now we continue to consume because of these software as a service models. We're always going to consume more data. We're always going to keep our iPhones in our hands. We're always going to be on the internet. This is constant regardless of a boom or bust cycle in the market. And this is constant regardless of whether we have a job or not, or if inflation is high. So we're always going to be consuming. And this software as a service model is reoccurring for these tech companies, which adds to their bottom line for earnings, which then adds to our GDP. And the macro picture has been bullish lately for the past few years. Our GDP has been really strong, even for a mature economy. We have record low unemployment. Interest rates are still historically low. Railroads are booming. We have an election year coming up, which is bullish because that creates gridlock in Congress. And now rate cuts are anticipated even more because of the weaker GDP print, which will help accelerate our economy again. The charts are also lining up for this thesis. If we go to a chart of SPY, which I've been pounding the table on recently, it looks really constructive. It had a bounce off of the 100-day moving average, as you can see here, the purple line. This bounce just came perfect, as you can see, right on the 100-day moving average. How is that a coincidence? And so I continue to remain a consummate bull on the market, especially when buying all these index funds that have high dividends, but you have to combine them properly. Cornerstone gives you your growth plus dividends. Defiance gives you your exorbitant dividends that go sideways but no growth, and Yieldmax gives you some growth and some dividends, but you have to trade those around their highs and lows because of the excessive NAV erosion. And I don't put much of my money in Yieldmax stocks because they can fall by the amount of the stock, whereas if you're in the indexes, you only fall by the amount of the indexes. And in many cases, Cornerstone and Defiance fall less than the indexes on a given down day. Also on a given up day, they might not move up as much, but they move up more than a JEPI. How did JEPI do for you all on Friday? For all those who love JEPI and Schwab D, look, it was up 0.3% on Friday, but if you go to CRF, once again, it was up 0.68 on Friday, and it moves upward left to right on its chart. You have to time this though between its rights offerings, which is in my volume 4 e-guide, because Cornerstone gives you 20 to 30% premiums per year plus a 20% dividend, and then it drips it down at the NAV, and it has 30% maintenance once again, which helps me anchor my portfolio to the indexes with a large dividend without taking up too much of my equity. Okay, so if you need any help doing what I'm doing, email me for my e-guides at akintodd48@gmail.com. Discord access is free for life, and my phone number is free for life when you buy my e-guides. Also, if you want to follow my portfolio to see how I'm getting this outperformance in the market, just click the join button on my wall, or I'll link that in the description below, and I'll talk to you soon, everyone. Thanks.